And I'm going to share my screen. So yeah, are you seeing my screen now?
Yes,
Yeah,
I can see your screen.
great.
Thank
Yeah.
you.
So in this webinar, we're going to be talking about commercial to residential conversions, and I'm going to run through a specific example of one that we currently have in progress. We're something like 60% complete on the works on this one. So why convert commercial properties to residential? So one of the key things is it's quite often possible to buy commercial value buildings at quite low value per square meter. Often we can find empty or undervalued properties because they might have been on the market for some time, difficult to sell, or we can get things in auction. And as a contrast, residential property, if it's in the right areas, which is in reality almost all areas, sell or rent at a much higher price than commercial property. So in general, the aim of converting residential to commercial to residential is to be able to get a significantly higher uplift in value than the cost of the purchase and the and the conversion to be able to basically there's two end strategies. One is to sell everything and to realize the profit, and so obviously get the return on the investment within the time frame of probably between 1 and 2 years. And then the other end strategy is to be able to refinance and rent out the properties for the ongoing income. If we're converting to standard residential, so like the equivalent like of a buy-to-let for standard family lets, in general, there's not enough ongoing income to justify refinancing and holding. And in that case, general will sell and realize the profit. If we can do things like serviced accommodation or HMOs or a mix of commercial and residential, then more often we're looking at refinancing to get ongoing income from the investment. So yeah, we've got consistent residential demand in the UK. Obviously, we know we've got housing shortages. We've got the government that wants to build, I think, 3 million houses. Obviously, there's quite a long way to get to, probably even a tenth of that. And also, even in urban centres, there's quite high demand for flats and housing. Third thing is that a lot of commercial spaces are becoming vacant. One of the key things that we see is, for example, banks. Um, High streets used to have 4 or 5 banks. Now they have between one and zero in practice. And yeah, things like Vasco was speaking about a former British Home Stores in Sutton town centre. Yeah, converted. This obviously is not residential, but it's converted to a different and really useful commercial and community use. So yeah, it's repurposing commercial properties that no longer have use. And we've got flexible investment sizes when we're doing commercial to residential. We can start like from a small, it can be like shop with space above that can be converted into residential, up to quite large multi-block units. So different types of commercial property that can be suitable for conversion. So we've got office buildings. Often that can be quite good to get started, especially if it's like open plan offices with lots of windows around them. it can be relatively straightforward to start reconfiguring, creating the partitions and almost like internal renovation. Then we've got retail spaces, which can be shops or banks, again, which can be converted. Then we've got things which are a little bit more complicated, like warehouses and industrial units. We're not really talking about modern metal framed warehouses. We're more talking about things like old industrial buildings, like brick built or stone built mills, often not far from city centres, which obviously they need sometimes quite a bit more work, but they can be quite high value because you can got buildings that have got high ceilings, a lot of space, and sometimes these are by canals or open spaces with nice views as well. And then we've got hotels and former public buildings that we can also, that's sometimes a little more complicated because there, if it's a hotel, it's typically got lots of rooms and we need to break probably quite a few things to convert into residential. How does it work with planning? So commercial and residential are different use classes. In England, most offices are now it's Class E commercial. Can so that also includes restaurants and other uses. Retail can be converted to residential under permitted development. So we haven't got to go through full planning. We just need to get local authority planning consent, which theoretically must be given, but there is some level of process that we have to go through. Unless there's what's called an Article 4 direction, which removes permitted development rights, or if we're dealing with listed buildings, that also we need to go through full planning. And if we're in Wales, also, there's no permitted development rights for conversion from commercial to residential, so we're always going through full planning. Going through full planning, a lot of people like sort of always like concerned if it's not permitted development. In practice, it depends on the local planning authorities, how fast they are, and it's possible to have a chat with local planning consultants. And in some areas, it's possible to get planning through quite fast. We can do pre-planning apps as well. So it's not necessarily a issue when we need to go through full planning. We just need to obviously plan for the right amount of time and ideally have a property where we haven't got bridging finance. Potentially, it could be a property that we bought at a quite low price in auction that we it could sometimes be a property where there's already partly maybe a commercial tenant in, so we've got some commercial income while we're sorting out how to convert it to residential. Regulations and compliance. When we're changing from one use class to another, so when we're changing to residential, the building regulations and requirements are almost identical to a new build. And quite a few people doing conversions end up, even I had one or two, we get one or two surprises from time to time, don't realize that, for example, we might have a building that looks fine in perfect condition as offices, but then when we come to convert to residential, we've got things here like, for example, insulation standards. We've got to have EPC C when we're converting to residential, which can mean that even if we've got nice plastered walls, we have to break everything, start again, and put insulation in. So there can be a lot of work there. Also, things like sound insulation between each individual flat. If the floors don't give the appropriate levels of sound insulation, we've got to break everything and almost start again. And things like fire safety, ventilation requirements. So need to be very careful and properly budget for everything that's involved. Same thing as well when we're converting. There can be a little bit of leeway on conversion, but in general, the space standards and size of bedrooms must comply with national space standards. So there's minimum size of like 7.5 square meters for a single bedroom, and it's something like 11 square meters for a double bedroom. And sometimes also we've got if it's like a large conversion, multiple units, we can have things like the ecological, environmental impact assessments. These are all things that we have to commission and pay for as part of the planning application. We can have interesting things like bat surveys and noise surveys and all sorts of things. So yeah, it's not like the same as renovating a house. Even if it's a small project, we need to be ready to navigate all the regulations and be sure that we've budgeted for that. Costing and funding options. Most conversions we do using bridging loans. Because obviously we can't get term finance on a project which is not immediately ready to rent out. There's an occasional exception for that where we're buying a commercial property that is let's say, at least half tenanted and has got enough commercial income to be able to support the lending, in which case we can get term finance right from the beginning, which obviously is less expensive and less risk because we haven't got to exit within 1 year. And then we can start looking at how we're going to develop the building, convert part of it to residential, deal with all the planning stuff, and then either we can get additional finance for doing the development work, or we can then use bridging, but when we're all ready to actually start the work. And quite often, even when we're using development finance, obviously development finance is covering typically 70% of the purchase price, and it can cover all of the development costs, but the lender only starts giving money for the development when a generally significant part of the work has been done. So in general, we need to be able to fund 15 to 20% of the development costs up front before we start getting money from the developer. And so very often we're doing commercial to residential conversions as joint venture partnerships. What this means is that there are investors, basically hands-off investors coming on board who are putting in primarily it's the deposit money. It's the money to be able to get the project off the ground. Or I'm bringing in, often with other property, experienced property developers, bringing in the expertise, sorting out the bank lending to be able to get the project off the ground. And then at the end of the project, the joint venture investor partners are getting their money back with the profit, or they're getting part of the money back and an ongoing share in ownership and an ongoing share of the income as it goes along. So yeah, different options for the funding. And also people come in as joint venture partners sometimes as well because they're looking potentially down the line to do a similar project directly themselves, but they want to get some experience, some exposure to how it works with an experienced investor, and therefore going into it as a joint venture. Because in fact, there are a lot of things to understand and to master on these type of projects. And also when going for lending, the lenders always are checking what's the development experience. They're asking the questions, give the developer's CV, give all the history of the previous projects that you've done. And if you haven't done any, it's yeah good to go in as a joint venture, get some experience before doing it like 100% yourselves. This is a real case study. This is a project that when I say we, this is set up as a joint venture. We'll look actually at a little bit more detail with the figures during this presentation. But in reality, there are four investor partners and two property developer partners in this joint venture. It sounds complicated, but in reality, it's not. The investor partners come on all with like similar terms. The main development partner in this one is myself, so I bring my development experience. I sorted out the bridging finance. In this case, I actually gave a personal guarantee on the bridging finance. And then there's a second active investment partner who is actually project managing. He lives locally and he's project managing the work. So what this project was is this building that we can see here, all in white. It's not that obvious from the picture, but if you look a little bit to the left, it extends out with a wing going out to the left. So we got this property with planning permission to convert into two three-bedroom apartments, and behind one house, or we call it a maisonette, over two floors with four bedrooms. So this was currently initially offices on the market at 500,000. We were able to secure it at 450,000. We estimated the cost of works to be 165,000. I mentioned sometimes there are surprises. There's one thing that we hadn't budgeted for, which we had to use some contingency on, which was because we're in Wales, whatever the size of the building, it requires a full sprinkler system. We hadn't actually budgeted for that, so we had to add that onto the costs. And then we're looking at a gross development value. So when it's finished, based on comparable properties in the area. And this end value was actually backed up when the RICS valuer came in to value the property for the purchase. The lender said, what is the estimated GDV? And the lender backed the estimation that we had given. What we're going to do with this property, because it's just over the border between England and Wales. It's right next to the Severn Bridge, so it's quite close to Bristol as well. But it's on the edge of a touristic area called the Forest of Dean. So what we're doing here is we're going to be operating this as three service department units. But what our plan is, so we're going to, when we're finished, we're not going to sell it, we're going to refinance it and hold it for the ongoing income. And we're going to be operating it either, we've designed it in such a way that all the units can interconnect with inside of the building. So we be able to accommodate large groups of up to, we're looking at like 22 people. We've created a large open space in the lower ground floor. Or when we haven't got the large group bookings, we're going to be able to obviously rent out the individual units. So this is going to be a high relative, well, compared to a standard buy-to-let, high cash flowing property. And we're looking at an estimated net monthly income with serviced accommodation of £7,700. And that is going to be shared between the all the partners in the project. What happens when, so we can see, in fact, if we do a fast calculation, the total money in is 615,000 plus legals valuation. So probably at the end, we might be at something like getting closer to 650,000, including the contingency. So that is giving us basically a 200,000 profit. When we look at projects, the way that we start is we're always looking at the end. So we're starting with the end value of 850. Generally, we want to get, especially if you're looking at selling, we want to get 20 minimum of 20% profit. So if we were to take that, we take this 20%, and that means that basically the money in should be no more than the amount that we've got here for it to be a profitable venture. In this case, if we were to sell, obviously we get all the money back plus something like 200,000 of profit. In this case, we're going to be refinancing, and the way that it's going to work is that the investor partners get half of their money back, and then they retain the part ownership of the property, and then the share of the ongoing income. In practice, it's going to be initially something like a 20% return, annual return on the money that's left in on the deal. And these are typically the type of returns that we, in inverted commas, have to get if it's going to be a good deal, and if it's going to be a deal that we can open to and make it sort of, yeah, interesting and profitable for joint venture partners. Here it's a bit small, but we can see approximately how it works. We've got the three floors. We've got the ground floor, which is at street level. Everything in red is how we are reconfiguring things, adding walls in order to be able to create the different units and the different bedrooms. And then we've got the first floor, which is a self-contained flat. And in fact, the right-hand part of the building, which is the wing, is over one floor and a lower ground floor. This is a little bit small, but can you see this? Raise your hand if you can actually see the figures on here.
Yes, I can see. Thank you.
Okay, that's great. Um, this is the type of analysis that we do. This actually is the result of a more detailed analysis, but it gives the overall figures. So yeah, we're always looking at the purchase price, stamp duty, so the total money, yeah, that goes in to the project. So in this one, there are four investors who put these amounts of money in, all of the investors getting at the end approximately half of their money back, and 20% return on, obviously based on the actual return is the share of the real net income. So, and then we've got how it works on the mortgage. So when we um, purchase the property, we've got development funding of 435,000 pounds, which covers the development cost and 70% of the purchase price. Uh, and when we finish the project, we're going to be remortgaging at 70% to pay off that will pay off the development funding, and will leave this amount of money to return to the investors. And then we've got the ongoing, when we've refinanced, obviously we're at lower interest costs. And we've got, so this is what it looks like: monthly net income before the finance costs, 7,700. Then we've got our estimated finance costs, and that's the money that we able to distribute to the individual investors. And this is the monthly amounts that the investors will be getting for the money that is left in. And then what we do as well, we do our simulations where we look over a period of 10 years. So there we're tracking the estimated increase in value of the property. We're tracking the net income that we're generating from the profit from the property. And then we've got the cumulative net income and capital gain. So over 10 years, we're looking at basically, obviously for all the investors combined, 1 million of net income and capital gain. And we've got this expressed as a percentage of the money left in the deal. So the estimation here is that over a period of 10 years, the overall return on investment for the money left in. So, for example, the investor that put 100,000 in, obviously he's deployed 100,000 for something like 12 to 14 months. Afterwards, there's going to be half of that 50,000 left in, and on that 50,000, basically over a period of 2 years, of 10 years, is expected to generate 200,000. Then we're looking at the how we're going to get the estimation for the serviced accommodation income. This is based on experience because it's obviously, well, not obviously, I'm doing serviced accommodation in other areas on other properties. So we've got a good idea of all the different costs. So these are the reasonably detailed. There's obviously behind that the more detailed calculations, but this is how we get our net income. Whenever we do a property, and we're always teaching this, we must have alternative exit strategies if our first strategy doesn't work. So in this case, we're looking to do serviced accommodation, and we're confident that it will work. But if something happens, another pandemic, or we can't imagine what, but and serviced accommodation, maybe some regulations that make it more difficult to operate. We've done our calculations based on operating the building as a 12-bedroom HMO. Uh, and here we still get a little bit less, but not that far away net income before finance costs. So we're able to get similar or almost the same income. And we've also done our calculations. The third exit strategy is to be able to sell off the individual flats and house, and obviously then just take the profit. I won't go bore you with all the details of that, but obviously when we're going into a commercial to residential conversion, we have to go into yeah, all the details of the costing. If it's a bigger project like a multi-unit project, we're looking at a project at the moment. It's actually in the same town, and this is creating 18 apartments, and a ground floor will be kept as commercial. This is a office block nearby. When it gets bigger than like that, we have to use quantity surveyors to get our estimations, and the lenders are going to require more detailed cost analysis. This, in reality, is a summary, and there's probably about 4 or 5 additional sheets behind that to get to our cost. And when we've done all our costing, we also, as like a secondary thing, we're looking at our cost per square meter. So here, we're not in London, we're in South Wales. We've got lower cost of wages. Materials are a little bit less expensive because there aren't the same like transport costs. If we're getting like loads of materials into central London, then obviously it takes longer. The costs are higher. So here we're actually, and we are more or less on track doing this project at £600 per square meter. And when we're looking at projects like this, we're looking is what is our purchase cost per square meter? What's our conversion cost per square meter? And what's the average residential price per square meter in the area? And that's how we like doing our first approximation. But obviously the cost per square meter on the conversion, it depends on the amount of work that there is to do. So yeah, this is just like a summary of what we do, finding the sites, the properties, looking at the planning aspects, doing the construction, getting it signed off, and then either exiting by selling or refinancing for the ongoing cash flow. Key risks and challenges. I would say the first thing is, apart from these things that are mentioned here, is that it's not simple. And if you haven't done it before, definitely recommend doing it as a joint venture with someone with more experience, or yeah, investing in a project, seeing to get yeah, basically exposure to how it works, or start with a small project like for example, buying a shop with a couple of floors above that you can convert maybe the upper floors into residential, and depending on where it is, potentially the ground floor shop as well. Success strategies, yeah, using permitted development where possible, but it's not essential. Working with experts, depending on obviously the size of the projects, or architects, quantity surveyors, planning consultants. Yeah, the big advantage of going into joint ventures, because it's sharing the risk and doing it with experienced developers, sorry. And then mixed use opportunities. We talk about commercial to residential. What we also like a lot is commercial to mixed use. And it's really good. I looked at one, in fact, earlier today, which was it's actually a former conservative club. Um, it was over 1,200 square meters. It's on a high street in quite a nice town. And the good thing on this one, it's actually got part of it is commercial rented out to shops. And this one it's in auction. We're looking at putting a bid in auction for this one. It's got a guide price of I think 225,000 for 1,200 square meters. So you can see how small the it's basically £200 per square meter. In this particular town, we've got residential at something like 2,000 per square meter, and we'd be looking at probably conversion costs of something like between 600 and 800 per square meter. So potentially profit of getting on for probably around £800 per square meter on this. And the really nice thing is the commercial income. There's leases on the three shops. I think there for 2 or 3 more years. Those leases already give a 5% return on the purchase price, so it gives some income that which actually cover the initial lending whilst we sort out the planning. And this we're going to be doing as a proposing as a joint venture. So yeah, I've said quite a bit. Gave an example. Yeah, get started with small things. Yeah, and people interested listening to this. I know a lot of people have asked for the recording. If anyone's interested in specific assistance or advice on getting started, can book a strategy call with me. Or if anyone's interested in getting into one of the joint ventures that we're doing, we've got ones of different sizes. Also, contact me. So we got to the end of the presentation. Are there any questions? Questions, comments, anything else? Yeah, go ahead, Vasco.
Thank you very much. Yes, thank you very much for the informative presentation, as always. So helpful to understand those things. I've just got a few things that I jotted down during the presentation. So
Yes.
firstly, I was just wondering, do you ever get any residential to commercial conversions? And the reason I was asking was that a flat that I used to live in with my family quite a while back actually is now actually a commercial property. So I was just wondering, sometimes does it go the other way?
Well, I haven't actually met that or actually seen a that as such. What we
Okay.
do come across more often is properties that were originally residential.
Yeah.
So these can be large houses in towns
Okay.
that have been converted to commercial and are operating as commercial. And there we're sometimes buying them as commercial assets, operating them as commercial assets. But a nice thing there is actually we've got the possibility in the future, if we want, to revert to residential if the
Right. Okay.
commercial doesn't work.
Yeah.
But
And
it's
then that,
interesting. I haven't come across, yeah, I've never in my experience come across the inverse.
Uh, yeah, maybe that was a previous era when that made sense. I'm not really sure,
Yeah.
but
Because in reality, the problem is in practice, in most cases, commercial property per square meter is less,
yeah,
is a lower price than
yes,
yeah, than residential.
okay, yeah,
So yeah, typically it doesn't work.
yeah. I've never. That's the
Unless it's
only.
a really specific case where there's maybe some professional who wants offices in some specific location and is prepared to pay a premium for that.
It's basically so next to the block of flats that I lived in. It was basically a converted one of those old Victorian type houses, so pretty or
Yes.
Victorian or Georgian or whatever. So fairly big.
Yeah, yeah.
And it was split into flats, etc. That was the first. So it's a long street, but that's the first resident. That was the first residential home. Next to that was, I think there was a pub and a garage or something like that. So what I think happened was, it got converted into a beauty studio or something like that. So
Yes.
it became one more commercial, and then the residentials started. So it's not
Yeah,
like a
yeah.
middle of a street of things.
Okay, interesting. Yeah.
Yeah. My next question was, have you had any roughly how many projects do you do at the same time, just out of interest? And have there, it's like a two-part question. And have there any that have not gone to plan? And have you have you dealt with those things not going to plan, etc.?
Yes. So typically we probably might be doing like two or three at the same time,
Okay.
but this is likely to increase over time
Yeah.
because when the projects, as the projects get larger, paradoxically, we're doing less direct work on them
Yeah.
because when there's one that we're looking at the moment, which is this one I mentioned, which is converting, it's actually a former mill which had been converted to offices,
Yeah.
and we've got an offer accepted on that. And this one, because of its size, it's 18 apartments and four commercial units on the ground floor. It's not the one that I can bring my build team from across the road and do it, sort of thing. It has to be done, even all the estimations have to be done by quantity surveyors, planning, the architects involved.
Mm.
And then when we actually do the construction work, we've got potential companies lined up, but that will be done under what's called a JCT contract,
Okay.
which is like a proper legally drawn up construction contract. So there's all sort of setting that up. And obviously there's going to be a bit of site inspection as things go along to make sure everything's going to plan. But once all that is en route, it's like the machine is going and then we can in parallel do the next one.
Okay. And
Yeah,
how
so
many?
potentially we could be five or six at the same time.
And how many sort of staff and contractors do you have to um, manage the projects? I'm just wondering.
Well, generally it's more rather than staff that we hire that are on payroll.
Yeah, sure.
It's
Contract.
generally either like, for example, on the one that I spoke about in this presentation, one of the joint venture partners who came in as what I'm saying is like a non-investment in the sense that he put a small amount of money in,
Okay.
as I did, but not very much.
Yeah.
This person actually is project managing the work.
Oh, I see. Okay.
And on this one, but he's not part of he's like a business partner, but he's not a shareholder within sort of my company. He's on specific projects.
Yeah.
We're doing things together.
Okay. And
So like on the large and then we've got planning consultants that we use quite a lot. So
mm,
again, for example, when we're putting together a the documents for the lender or potentially for investors, we're saying, look, these are the solicitors that we work with. These are the planners that we work with. This is the company. If it's like a small company, if it's a small development, and I'm using my development company, then I'm saying, look, this is a development company. This is the examples of things that we've done in the past.
Yeah. And how many projects have you done in total, approximately? Just wondering.
Yeah, something like I would say probably something like a dozen projects,
Okay.
ranging from smaller ones to obviously this one that I mentioned there is one of the bigger ones.
Yeah.
But then now we're sort of now that we've sort of got a really good idea of yeah what can go right and what can go wrong,
Okay.
and basically everything that needs to be taken care of, we're yeah able to do the bigger ones as well.
Okay. Thank you.
And the generally what can go wrong, like for example on this one I mentioned, we hadn't it's also like experience taken into account the fact that we had to put in full sprinkler system, which so sometimes there are things that add cost to it.
Yeah.
Major problems, we always try and be conservative when we do our figures at the beginning,
Yeah.
so that we've got enough margin for errors, and so we can correct them as we go along.
Okay. And have the investors ever lost money, or has it been more or less to plan in the end? Just out of
It's
interest.
been more or less to plan. No
Okay.
investors have lost money.
Yeah.
What occasionally happens, and this actually is part of the shareholders agreements,
Okay.
when I come into a joint venture, I've got a significant amount of equity for not putting any money in, because obviously I'm bringing my experience.
Right.
And
Okay.
then there's the investor partners who are putting the money in.
Yeah.
And so with my equity, obviously I have a share of the ownership and I have a share of the ongoing income.
Okay.
But what happens in the shareholders agreement? Let's say that the agreement is the guy that put in, let's say you come into a project, you put in 100,000, and the agreement is that when we refinance, you must get 50,000 back, and then afterwards your share of the ongoing income. If
Okay.
the refinance only enables us to give you 40,000 back,
Yeah.
what happens, and that has happened once, what happens is that all the ongoing income is used first of all to
Oh.
repay the what goes to the people that actually put the money in
Okay. Yeah.
before it starts being split equally between all the joint venture partners.
Yeah. So you've got a different uh class of share and seniority
That's
compared
right,
to.
yes.
Yeah.
Yes.
Okay. Got.
Yeah, so there's the risk. Basically, generally the biggest risk is, I mean, obviously there's risk that everything goes completely wrong, but I think
Yeah.
we've got enough things in place to avoid that. The risk
Okay.
in reality is if the things go a little bit over budget,
Yeah.
or often the biggest risk if we don't get the end valuation that we want if we're refinancing, is we've always got plenty of margin, obviously, to be able to refinance and get out of the bridge. But yeah, if we haven't got enough refinance to pay back the investors, then yeah, there's effectively what you call the seniority that they
Okay.
get, yeah, which is based on the different classes of share.
And what for the bridge? Sorry, I'm asking lots of questions now.
That's fine.
For the bridge lending, what roughly what kind of percentage rate, annual rate are you talking about
We're
there?
talking about 1% per month in general, so
About 12.
12%
Okay.
per year.
Okay.
And
Excellent.
that hasn't changed.
Yeah.
And obviously with the bridge, which is like on this, we haven't gone that much into the finance stuff.
Okay.
This project that I mentioned, that I spoke about as the example, we actually completed the purchase at the end of March, so let's say the 1st of April to keep it simple. The building work should take 6 months. and we are actually at approximately 60% complete. So we should
Okay.
be on schedule for that. And the aim, we're already starting, we being me in this case, already starting to consult banks. Even though we're like 2 months away from completion, we're already consulting banks for the refinance.
Okay.
So that on this one, on the amount that we have to repay on the bridging is based on 12 months.
Okay.
Obviously, here in reality, we've overrun on the cost because we had to pay an extra £12,000 for this sprinkler
Okay.
system.
Yeah.
We're also planning on, and that's with the agreement of shareholders, we're going to be spending something like 10 to 12,000 on solar panels because
Okay.
that actually will give us a higher EPC level, potentially lower interest rate because of that on the term lending, and also
Oh, right.
within
Okay.
I think 4 to 5 years, it's already paid for itself.
Yeah.
So, what will happen if we can refinance within 1 or 2 months of completing? So, let's say within 8 months rather than 12 months,
Yeah.
we've saved 4 months of bridging interest and we've potentially paid for these additional costs.
Okay. And the bridge finance, is that unsecured? Sorry, I'm not that familiar with this, but is it unsecured lending or is it second charge or
No, it's first charge lending.
oh, the
Yeah,
bridge is
when we
first
say
charge.
bridging finance, what it
Yeah.
means, because when we buy a commercial property and we're going to convert it, we can't use long-term finance.
Okay.
A lender won't say, we'll lend you this amount of money for 10 years
I see.
because they need to be. So basically, they're saying it's a higher interest rate because obviously there's a bit more risk for the lender. And typically it's for 12 months or it can be 18 months.
And the reason is because it's not getting an income while it's being
That's
redeveloped.
right, yes.
Okay.
Yeah.
All right.
It's the
Excellent.
same thing, for
Yeah.
example, on more basic like buy-to-let properties.
Okay.
If a
Yeah.
property is more or less ready to let, just needs like a light refurbishment, coat of paint and stuff like that, we
Okay.
can get term lending. If it's got needs a major refurbishment, like rip out inside, it hasn't got working kitchen and stuff, it's not
Right.
possible to get standard lending.
Yeah.
So, and that often is a strategy we should call buy, refurbish and refinance,
Yeah.
because they're obviously buying at a low price. We get them in auction. We and there we have to use bridging finance.
Okay.
So that's basically finance for 12 months at effectively this 1% per month interest. And then we're like sort of in a race to get it done as fast as possible. We're not in a race because we're afraid that we won't complete in 12 months, because we've got
Okay.
to be really bad to not complete in 12 months. We're in a race to save money for the investors on the
Yeah.
bridging to be able to get out of the bridge into the term loan.
Okay.
So yeah, it's exactly the same on these commercial to residential conversions.
Thank you for addressing all my questions. That's really really informative as well. And incidentally, I think you also mentioned that okay. You also mentioned that you have sound I think sound tests and
Yes.
etc. So I just thought I'd mention that my main employer is deals with so Cobra sliding systems and trim acoustics, deals with sound tests and insulation and also sliding and folding door systems. So if you ever,
No, no, it's actually very interesting. Yes.
yeah,
Yeah.
so I'm happy
I
to.
mean, here in general, yeah, we're talking about generally fixed partitions, like between flats and things.
Okay.
And effectively, that, especially when we're doing conversions, that is one of the most difficult things because there's all sorts of ways that sound can get around, like little holes and different things.
Oh, yeah. I used to, there was one point when I was sitting next to some of the people in that division of the company, and I used to hear their phone calls, and they used to get all technical um, with the like information, etc. So
That's right, yeah.
yeah, it was quite interesting.
And
So,
then at the end, it's always not exactly nervous, but when you've finished everything and it's all like complete, they're
yeah,
coming in and doing their tests. And you're
Okay.
thinking, is it going to work, or am I after going to break something and do it again? And
Oh, I see.
yeah,
Yeah. Well, I can certainly, if you need any introductions on that side, I'm happy to.
yeah.
I'm
Oh
happy
no,
to
that's
do
great. Yeah.
that. Thank you.
Right.
Are you doing sorry, are you doing another webinar on one of the projects? Sorry, I didn't really understand um, the messages that you sent. Is there an 8 o'clock webinar as well on one of the projects?
Actually, the 8 o'clock one isn't going to go ahead today because,
Ah, okay, fine.
yeah, some people couldn't make it, and we're probably going to
Sure.
redo that on Thursday.
Okay, yeah.
And that is actually for a specific commercial property investment that a number of people are interested in, that we're going to go through the figures
Okay,
on
thank
that
you.
one. So yeah, so there isn't a follow on today, which is why I'm not in a massive rush to finish.
Okay, yeah.
Yeah. Are there any other questions? I think there's Ope on the call as well. No, so no other questions. Well, I hope that was useful for you all, and useful
Yes.
for the people that are going to be listening to the recording. And yeah, so thanks for your time and have a good evening.
Thank you very much.
All
Thanks.
right, yeah. Bye.
See you. It's good timing. Good timing as well. Because yeah, I think this place will be sort of shutting down and things as well.